Good day, fellow investors. Occidental stock is down recently, but Warren Buffett has been buying more and more, and therefore it is time for us as value investors here to analyze the situation, the risk and reward, to see what kind of an addition Occidental, which is a buy if Buffett is buying, can be to your portfolio. But before discussing Occidental, the key factor when it comes to oil stocks is oil prices. Therefore, we'll start with oil prices and the oil price outlook long term. If we look at oil prices over the last 5 years, we are now somewhere mid-level. We have seen high levels in 2022 and we have seen very low levels in 2020 due to the pandemic. But if I go a little bit more into history, look at what has happened. So we have had an ugly or relatively flat situation for oil. Then as China, emerging markets boomed, we have seen very high oil prices. Then we have seen it drop during the great financial crisis, high investments, low prices. Then we have seen very high oil prices, and now we are somewhere mid-level. Of course, I think this situation here is something exceptional, thus it cannot be repeated, hopefully not. But if we compare to the lows of 2015-16 on oversupply, if we add the inflation, production cost, shipping and everything to the current situation over the last 9 years, we might also say that we are close to long-term oil price lows from that perspective. So we are at mid prices, but what is the outlook? From one perspective, in a few years, it will all be robotaxis, electrical vehicles, and then we will not need oil anymore. But just for some fun, I went to Google Maps, I went to Tirupati, then went to the street view, and I found this. And robotaxis and this, it will take some time. Plus, if you look at the global population, developed markets where we can see robotaxis in the next decade are just a very small part of the global energy consumption pie. Therefore, also, if you look at the energy use, it's highly correlated with gross domestic product. As GDP increases, so does energy use increase. And there is still a few billion people that hope on economic growth and therefore also higher energy use. If we look at the energy use per person, of course, United States is very high, Europe, China has reached Europe, but the rest of the world is still very low. And looking forward, yes, it is likely that renewables will make a larger and larger pie of the production of energy, but as the demand increases, it is also likely that demand for oil, even for coal as traditional fossil fuels, will not evaporate. So yes, everyone is working on substitution, but that, as we are seeing, is taking a lot of time. I've looked at the short-term energy outlook to discuss the short-term implications, which have a high correlation to the stock price, and I have seen that the forecast for the next 2-year oil prices are pretty low on increased production, increased supply, compared to stable demand. And also OPEC, if you read, they are committed to stability, so even in a little bit increasing production. And if we look at the supply and demand, towards the end of this year, we should go into oversupply, which should mean a little bit lower prices. Of course, it is impossible to predict. One change in decision from the OPEC, a recession, this or that, can have huge impacts on oil prices. This is what we know now and what can happen going forward. And you can see here predictions are for lower prices, and we'll see later in the Occidental analysis that has a huge impact also on profitability. Production is expected to grow, OPEC stable, others are growing, and consumption is also expected to grow. If I go to the World Energy Outlook and I look a little bit at what's going on, we have three scenarios. The STEP scenario, the stated policies scenario, we have the announced pledges scenario, and the net zero by 2050 impossible, unfortunately, scenario. And still, fossil fuels went from 83% of global energy consumption to just 80% of global energy consumption over the last 15 years. Thus, fossil fuels are there, are stable, and that, as much as we might not like it, is the unfortunately real situation out there. And the outlook is for stability in the energy production, let's say, market share. If we look at the situation and if we look at the investments, the reality is that there is still very much investing in oil, natural gas, coal, and then just a little bit into the low emission fuels. In other pledge scenarios, this changes, but we are not yet seeing that, especially with the new drill baby drill policies that is also changing. And here we have the table discussing demand growing to 2030, then declining a little bit 2035, and still stable till 2050. If we look at oil prices there, they estimate on current levels, of course, those to be stable, but whenever you look at these predictions, those predictions will always be linear. Here we have a little bit down, but still that is 2050. We have to look at 2035 for our investments, and we see demand higher and supply on current data lower, which means we can even see higher prices. Of course, oil prices will go up and down, but projections are all straightforward. This we are not yet seeing, but even in that environment, still 2030, this is a little bit stretched. I think that demand will start declining. We will have to see about that. Then, going forward, if I look at the cost curve for oil, the marginal cost, we are now trading around there, 70, 80, also want to make some money. Of course, globally, if we look at production, we still have 10 years of low-cost production, and then you have these marginals that need higher oil prices to justify production. Of course, most of the cheap oil, Middle East, and then we go on to other. Now, from what I sense now, we are in a mid-price level, and the future, the outlook for oil prices will depend on shocks, be it negative for the environment and positive for lower prices, or perhaps negative recession or increased production, or perhaps positive lower demand going forward that will lower oil prices. I cannot predict the future. I can just see, okay, at this point in time, at this level, this is the risk, this is the reward. Unfortunately, my crystal ball broke recently and I cannot see in the future anymore. Therefore, we'll have to stick to risk and reward analysis. Now, if we look at Occidental oil and gas, 75% of capital investments is Permian, US, shale oil, and then there is some chemicals, there is some midstream, there is some international, but mostly it is the US. 1 billion pre-tax income from Oxy chemicals, okay, but this is the key. Permian, DJ Basin, Rockies, so they are producing their things. They are also doing something related to CO2 capture, so okay, to go a little bit more green, but the key here now is that 2024, 4.9 billion of free cash flow, they have divested some things, they have lowered their debt after the Crown Rock 12 billion acquisition. They're focused on lowering debt, and they will continue with some divestitures, used to repay debt, lower interest payments, and increase dividends from those lower interest payments and lower debt burdens. This is the situation. They have significant investments like all oil companies. They will invest likely 7.5 billion in 2025. So you need to invest to keep that production high. You can see here Permian, Rockies, International, and then others are there, not that relevant. The key when it comes to oil, and why we discussed oil prices and the outlook there recently, annual cash flow changes, 260 million for $1 change in oil prices. If oil goes from 75 to 65, that is 2.5 billion less in the free cash flow. So this would go minus 50% if average oil prices just go down 10%. Then there are others, but it is all related to oil prices. And if we look at the situation, if oil prices go 60, a little bit below 60, Occidental makes zero. Because they have, yes, lower break-even reserves, higher and a little bit higher at 60, depending on what the oil prices is. They have improved the break-even a little bit, but as we have seen on the chart here, it is not the cheapest source of oil out there. It is cheap, but not the cheapest. Then I looked a little bit at the debt, long-term debt, 25 billion, which is what they want to lower, but still there is 34 billion of equity. I have looked a little bit at the net income, and you can see here how net sales are 26 billion, but the profit is just 3 billion. So just a small 10% decline in oil prices, all else equal, there is not much profit left. This means that the margins are thin, which means when oil prices go up, Occidental stock shoots up. When oil prices go lower, Occidental has issues, which is what we are seeing now on the stock price, given that oil prices have declined. Now, they have made an acquisition, 12 billion. They say it will immediately increase their cash flows, 12 billion, likely 5-6% cost on debt. They will get 1 billion of cash flows, so that is their positive, and as they lower their debt, they should get this 1 billion and then perhaps even higher rewards from the acquisition. And they have increased their unconventional sub-40 break-even inventory by 33%. As said, if oil at 100, this booms. Now, I always look also at the conference call, what's going on when it comes to the company. And as they say, they are lowering the debt, lowering the interest payments to try to pay more dividends. But key factor is always oil prices, $10 down, 2.5 billion for Occidental. When it comes to the questions, just one quick laugh. Gulf of Mexico question, Gulf of America answer. So they are pretty set on that. Very interesting, and I find it funny. But okay, this is a good question here. Their target is 15 billion of debt, thus 10 billion down. That is 33% of less interest payments. That would then push the dividend higher. Of course, if they succeed, and that is something we'll do in the intrinsic value calculation, then the dividend should also go higher. So if we go to our free intrinsic value table, I have added Occidental here. We'll add it here and upload it on the free investing course. So Occidental, here we have. Now, first I have cut out the present value of the first 3 years of dividends, and then I have put in a 100% payout ratio, as they could be paying, let's say, all the free cash flow they are getting now per share in dividends. So let's just write here per share, not in billions, as we are close. If that happens, the free cash flows grow at just 4%, the discount rate 10%, terminal multiple on the free cash flows 10, then the intrinsic value is 51 per share, which is close to where we are now, and that explains why Warren Buffett has been buying, because 10%, his target is 8%, it's better than 3-4% he's getting on treasury bills, and that is why he is investing. But keep in mind, this is oil. At 70, this is the situation. However, if oil prices go to below 60, there is no free cash flow for Occidental. Then there is surviving. And then you cannot value it. The market might panic for who knows what reason. And that is the short-term risk of it. Of course, oil prices should then stabilize over time. OPEC will cut production, and therefore then it could again rebound, lower investments, and then you can again see 100 maybe 4 years from now. And that is, let's say, the volatility that Warren Buffett doesn't care. He has made the calculation on average, I don't know, $5 per share in free cash flows. That is something that checks his box, good assets, and that's about it. He is happy with that. However, if we look at opportunities, then we must know that we can go lower in stock price, 30-40% lower, but we can also go higher. And that has happened already on the lower side, higher, higher, lower. So you have to see how that fits your portfolio, because it is risky. Here I just wanted to discuss what I do on my research platform, which will give you context on whether I will include Occidental or not into my situation. So here I received an email, thank you for the past 3 years. I went from being a speculator to confident investors. So what we do on my research platform is try to find good value investments where the risk is low and the returns are much, much higher. And with what I'm seeking and with clients like this, I cannot go and bet on Occidental. Even if Warren Buffett is betting, but Warren Buffett doesn't have any other eyes on his portfolio or connected feelings. So I personally, also to make it easier for me, I have to wait for a margin of safety, for a value investment, or for higher rewards from Occidental when it comes to the long-term outlook. So I might wait 2025, 2026 to see perhaps a recession, lower oil prices, and then I might take a bite of it. If I look at my diversified portfolio, Occidental now gives me 10% free cash flow yield, perhaps a little bit lower, and I have already 15 positions there looking in some other things, so it has not yet triggered the okay, now we can start with a position. However, when it comes to you and your portfolio, you might, if you like Occidental, if you like Buffett's long-term strategy and the long-term outlook for oil, you can start a position now, let's say 3%. If we have a recession, oil looks very ugly next year, then you can increase the position from 3, it goes to 2, you increase from 2 to 5%. And then when oil, again, as the cycle goes, rebounds much higher, you can then bring it down to 3. And so, alongside the dividend, the free cash flows, Buffett's security, because if Berkshire owns 30% of the company, it has unlimited access to capital, thus it can survive whatever. And therefore, yes, you can make money over the long term from Occidental, which makes it a rare exception in this market. It doesn't yet fit my preferences and requirements. I would need more, let's say, stability or lower prices. Usually, if you are looking for cyclical bottoms, you look for 20% free cash flow, 15 to 20% from oil producers. So if it goes down another 30%, then it might be interesting, because likely oil prices will be just temporary there, while then remains the upside of when the cycle eventually turns. Thanks for watching, smash that like button if you enjoyed this analysis, and I'll see you in the next video.